So thank you everybody for joining. My name is Scott Callan. I'm the chairman of Ichigo. We're really grateful for your time. I'm joined today by Ted Fujita, who is our lead independent director.
Yes. Hello, everybody. I'm the independent, the external board member and the chairman of audit committee. So normally, I keep very quiet. But if you have any questions, please, address to me. I'm very happy to answer any questions as an external board member. Thank you.
Thank you, Ted. And also we have with us Dan Morisaku, who is senior member of finance team and our head of global IR.
Hi, I'm Dan Morisaku. I have calls with many of you before and excited to join the global conference this afternoon here in Tokyo. So thank you for joining with us.
All right, let's get started. I'm working off of the presentation. It is on our website, FY22, so it's the February 2022 fiscal year, H1 first half corporate presentation. Again, thank you so much, everybody, for joining us. We're grateful for your time. Let me turn to the first page of the presentation, which is page 8. Probably the most important thing that has happened is actually not on this page, which is Corona and COVID. So this quarter, so the second quarter, is the June, July, and August quarter, in which Japan experienced an unprecedented surge of cases and fatalities. It was an extraordinarily difficult time for the country. And since so then in August, and since then, there's been this equally extraordinary collapse in cases and fatalities. Delta is all over Japan, just like it's all over the world. We're still trying to figure out why exactly this has happened. But we are sitting today in October together, here in Tokyo and those around the world. But in Japan, we're in a totally different world than we were in Q2. At this point, 90% of those over 65 or older have been vaccinated. It's 66 totally vaccinated. 66% for the country twice, and 75% once. So it looks like Japan is going has relatively low levels of vaccine hesitancy. It's looking like it's going to go over 80%, and possibly could go as high as the mid 80s. So that's apologies. That's not on the page because that's not about Ichigo, but it is about the country and the environment we're operating in. So Japan, knock on wood, has turned a corner in a very, very powerful way, which changes everything for us going forward. And so it's not the most important thing, it's the most optimistic, positive thing I can tell you. We're glad to be in Japan, which is back, and Ichigo is going to come back hard and fast. So anyway, turning to what's on the page, hotel earnings recovery is slower. When I spoke to you in July, we were reflecting on that Japan seemed to have turned the corner on COVID before this explosion in Delta of the cases. And there was, looks like it was going to be the case that we're going to have a recovery both in hotel occupancy and in activity in the hotel buy-sell market, and that didn't happen. When things turned really, really grim, we had a plunge in both a state of emergency in much of the country and a plunge in activity. Those people would say, "Hey, we're interested in possibly buying hotels," but they all canceled. So the hotel earnings recovery has been pushed back, and we think that's the answer, that it has been pushed back, and therefore kind of we're possibly delayed 3 months to 6 months. Given what's happened at this point, we're clearly in a state where the hotel earnings are going to rebound very, very substantially. There's been a minimal COVID impact on mid-sized offices, which is overwhelmingly where we play. I will talk about the one big asset we have of Odaiba, which is big and important, which is in a very different world. We're having extraordinary, strong, stable NOI out of our mid-sized offices, and Odaiba is different. It's a large office. There are challenges leasing it up, and I'll speak to that in some more detail. Clean energy is growing extraordinarily well. That is, of course, completely unlinked to the economic cycle and to COVID, and so that's really exciting. We were, for the 6th year in a row, chosen for inclusion in the JPX Nikkei 400, which is arguably the index of Japan's premier companies. It is thought by the JPX Nikkei to be the index of Japan's premier companies in terms of value creation. And we think since we exist substantially to create value for the world, including our shareholders, that makes it the premier index in Japan. And we qualified for the TSE Prime Market, so we will move on to that on April 4th, 2022. Page 9 speaks to highlights on earnings. And by the way, this was a light quarter as expected. So in the first half is light. We have flow earnings that come out of our value-add business that move around. We do not spend a lot of time trying to position those earnings in any one quarter. We think that's the way you lose money rather than make money. So it was a light first half. Nonetheless, the firm has got very durable earnings. Stock earnings, so those effectively fixed earnings, come in at twice our expenses. You see on the right side some decrease in stock earnings and stable real estate. So this is primarily rental income, and this is Odaiba. This is our one big asset, which I'll be speaking to, is experiencing more vacancy than we would have expected. Asset management, on the other hand, is up 17%, and clean energy is up 14%. Turn to page 10. What's I think is most interesting about this, as it speaks very directly to the difference between accounting reported earnings and we would describe as economic earnings, or which are linked intimately to cash generation. So to be clear, we are all about rigorous, systematic, relentless focus on cash generation. So the headline accounting numbers look poor. They were as expected. Those accounting numbers will improve very, very substantially. But as I said, you've got OP down 22%, you've got net income down 38%, you've got cash EPS only down 2%. And that speaks to, the fact of the matter is that accounting has a whole bunch of non-cash stuff lying around in it. And so what's important to see is despite the significant drop in earnings. I mean, accounting earnings, of course, are linked to total earnings. We continue to have very, very robust cash generation. So it's a way of saying when the accounting earnings go up, and they will go up, you'll see cash earnings going up also very substantially. Page 11 gives you the sector breakdown. OP, you've got asset management up 27%. That's primarily on increase in Ichigo office-based asset management fees. Sustainable real estate business has got stock earnings down. That's primarily on depreciation expenses, so those are non-cash. But they, of course, they hit the OP line, and that's down 7%, and the rest is a significant drop off in flow earnings. That is effectively entirely because we did more value-add sales in the first half last year. We're going to do more in the second half, so nothing to worry about there. Clean energy continues to grow very, very well. We had a first power plant we brought online this year, and that is contributing to the earnings. Looking at page 12, I think it's probably most important to focus on what's changed between Q1 and Q2. And so I won't go into particular detail on that, on the unchanged parts. So stock earnings, are relatively unchanged from Q1. Very, very high impact on hotel. Not a lot of impact at all in either office, as I described. And however, I should say that's primarily mid-size office. So we have one big asset, Odaiba. It's large-scale office. It is experiencing more of an impact. Since most we own is mid-size office, we're speaking to that on this page. Residential and clean energy, of course, are having no impact. When I say, of course, clean energy, no impact. Residential, since Japan has done a very good job projecting income, there has been no impact on that performance. Turning to flow, the big change is in office, or the two changes in office and retail. Those markets are clearly coming back. What was unexpected, and which I just touched on, was we thought hotel in terms of buy-sell activity. So flow earnings are about buy-sell activities in these asset types. We thought hotel was coming back. It was coming back, and then a sharp U-turn to, wait a minute, we're not sure we want to own these assets anymore. Let's see what happens. Given that we've got, effectively, as I said, we've broken the back of Delta in Japan at this point. We expect the hotel activity to come back, probably pushed back 3 to 6 months. Pages 14 and onward speaks to the business model, and I've touched on this before, so I won't go into great length, but happy to take any comments or questions in Q&A. It's both a stock plus flow earnings model. Stock earnings massively cover our expenses, so we effectively are structurally earners, and on top of that, we think robust and high value, high quality flow earnings. Page 15 shows you the embedded forward earnings. So, again, it's important to understand that, and we're fine with this, but it's important for investors to understand that full value creation is not reflected in accounting earnings. It's not only about the cash generation being different, but it's also that we do value add, and it creates value, and that value is only recognized both on an accounting and on a cash basis when we do a sale. And so what that implies is you have significant unrealized gains that are on the balance sheet that are an earnings bank for future periods. If you turn to, and currently these are external third-party appraisers, they think we've got about 64 billion yen of unrealized capital gains on the balance sheet. That's against a book right now of about 100 billion yen, so plus 60% against book value. If you turn to the next page, it shows you that we systematically outperform what the third-party appraisers think in terms of the actual value created. Generally, it's between 2 and 2.5x of what the third-party appraisers say we're going to earn. If you see, in this year, H1, we actually have a very low number, 1.4x. That's linked to us deciding to dispose of a bulk kind of regional residential portfolio that we didn't experiment on, didn't make much money, didn't lose money, but effectively we exited that at no real profit. So we think the systematic normalized trend continues to be about 2 to 2.5x what third-party appraisers are saying. So even as low as 2x, given COVID uncertainty, that implies we've got about 130 billion yen at least of unrealized gains on the balance sheet from real estate. Again, that's more than our current shareholder equity. That does not account for what we think is a very, very large amount of unrealized gains in our clean energy business, and I'll speak to that later. Page 17 also speaks to how we're very focused on robust cash generation, and it shows up in our economic operating cash flow systematically being higher than our income. Page 18 shows our financial base, continue to borrow very long, so we have the ability to finance our assets through kind of, very long time. You'll see that there's been some drop off in the period of kind of the remaining loan maturity. That's linked to the fact that Ichigo's owner's business is an increasingly large part of our business. I'll speak to that later again. Average holding period in this business is less than a year, it's 0.8. What's that? Something about 9 to 10 months. And so we tend to borrow in that business around 7 years. We don't need 7 years. We're actually very conservative in making sure we have a balance sheet that's bulletproof. So that explains some drop off in the period. But again, robustly, massively longer period maturity of liabilities to finance our assets. You can see there continues to be a drop off in the interest rate that we pay. Page 20 is acquisition and sales during the first half. Almost entirely on the acquisition front was Ichigo Owners. Again, that's a business that does prime, arguably super prime, almost entirely Tokyo residential. And if it's not Tokyo, it's kind of in a prime equivalent, and brand new residential assets. Super liquid, good value. And for investors, this has been a very, very attractive asset class, given how robust its performance has been despite COVID. It is worth pointing out that sales have been 11 billion, but we did a large sale, which is already disclosed to the market, about 18 billion yen of 16 residential assets out of Owners to a domestic buyer. So that's been contracted and that will close in November. So the way of saying the earnings, the earnings from that are coming in, and again, we'll hit in Q3. On the page, net acquisitions slightly higher. And this is again, residential for the Owners business overwhelmingly. It's worth pointing out that the residential sale that we did here of 5.3 billion yen was an experiment, and we do experiments, and we think that's valuable and important. This was arguably a failed experiment. We bought kind of a normal kind of, so the owner's business is brand new assets in great locations. It's gonna get arguably super prime. We thought it was worth looking at whether or not we could generate value in regional residential kind of, the typical kind of aged set of 10 to 15 years, kind of old multifamily, perfectly functional. Proved to be a harder business all over the country, not great economics in terms of cost structure for us in order to maintain kind of and drive value there. So over a number of years, we sold out of this portfolio. Was originally over 10 billion yen, 100 million US, and we did the final exit of it. So we are now completely gone out of used regional residential assets. Page 21 gives you a view on what's happening with owners over time. This is a business we set up 4 years ago. It's going extraordinarily well. We have and there's an engine, right? So you buy assets and then you want to sell them. And so we all obviously want to be buying assets because we have a robust sales pipeline and sales activity. At this point in H1, the progress against our target for acquisitions is 72%. That on executed contract basis. If you include kind of the pipeline of we think we're going to get this done, it's about 90% of it. So owners feeding the owner's engine is going quite well. Page 22 speaks to kind of the value add business in sustainable real estate. I won't go in too much length because I'm pretty sure most of you are familiar with this. It's worth pointing out the NOI uplift in our sustainable real estate business has been about 20%. It's been 25%. That's a weighted average. And what it gets at is, the fact that we're selling these assets at a profit is intimately linked because we make the assets more profitable. So you push up the NOI by 25%, you sell the asset up 25%, you're just selling it at the gap rate that you bought it at. When it's become a better performer, you generally get a premium for assets that are performing better. So you can see that the gross profit margin in the multi-asset business, so that's got an average hold of 3 years. It's been 32%. Owners is a much higher turnover business. We like that. I mean, you're not taking risk on a holding period. It's less than a year. It has a GPM of about 11%. They are different assets, different asset classes. Multi-asset is at this point doesn't do much residential. Primarily it's office, it's hotel, it's retail. Owners is exclusively high-end, brand new. Again, overwhelmingly Tokyo residential prime areas. Page 23 speaks to what's happening with the two REITs, Ichigo Office and Ichigo Hotel, along with Ichigo Green, our listed solar power producer. It's worth noting that Ichigo Office is en route to being the first J-REIT. We think we'll have to see if someone beats us there, but it expects to convert over to 100% renewable electricity and primarily solar and wind by April 2022. That would make it the first Japanese REIT to achieve that. Across the firm as Ichigo, we expect to hit that by 2025. I mean, arguably we're already there. But the RE100 rules don't allow you to count your production. So we're producing the energy we need, renewable energy we need through solar and wind in order to do everything we need for ourselves. RE100 doesn't count production, only counts what you buy. So anyway, but the Ichigo Office REIT we think will be the first J-REIT to get to 100% renewable. Page 24 shows what's happening in the clean energy business. On top of the pipeline that we have here on the far right-hand side, which is the kind of royal blue part of the graph, is green biomass, which we're working on. We also expect will be a significant earnings driver. That is a brand new business. We're actually pretty conservative in the way we think about how we describe our pipeline, so it's not in here. But we fully expect that to begin to happen in the next 18 months. It's also worth pointing out that there was a truly spectacular announced transaction where NOS, big Japanese oil company, is buying the solar, primarily solar, well, actually it's not primarily, it's a renewable portfolio, solar and wind from Japan Renewable Energy at about 200 billion yen. Their current, that business's current revenues are less than ours. Its OP is less than ours. They have a stated pipeline, which is bigger than ours, but it's actually worth pointing out. You see on this page that the average fit we have is 31 yen, and the current, and so, you know, and currently, you know, if you are selling solar power, for example, it's going to be about a third that. So it's a way of saying we were involved in this business very early with very high tariffs. And so it's so, for example, we've got currently 130 megawatts going under using the current fit. That would be something that looks more like 400 megawatts. So the economics are radically different for a portfolio of cars that has it's just super normal returns attached to them. So anyway, we think that's a super exciting transaction. We need to do a lot more work on it. It does speak very directly to, we think, a very high possibility that the market is systematically and very significantly undervaluing our clean energy business. Page 25, Trade Pia Odaiba. This is the large asset that I spoke to. It's so big, it's actually, it's about 10% of our total assets. It's 40% of our office portfolio, which means it's a minor, but it's big, so it's really, really important. We got an S rank, which is the highest CASB, so this is renewable, sustainable building certification. It is our second asset, which is won the S rank. You know, why do we do this? We do this because we care. You know, Ichigo works to be good for the world. Not only do we care, but our investors and global, particularly global investors, increasingly Japanese investors care. I point this out because it's not clear at this point that tenants really care. So when you do work to make a building more sustainable, it's good for the world. It's good for all of us. It's good for growing asset value. But what I'm telling you is it's not necessarily good for growing NOI, meaning it's not clear at this point. And we hope this will change. The tenants will increasingly realize the value of being in a building, which is right for the planet and right for society. But at this point, we don't get a premium rent on it. But we do get a premium in terms of value creation. What I'm telling you is effectively a low cap rate. So we think this is a very, very positive for Odaiba's value. And then, you know, this is a page about kind of Odaiba as a sustainable building, but it's worth pointing out that we are experiencing a very different leasing environment for this. So this has got floor size generally kind of 5 to 10 times bigger than our mid-size assets. And it's clearly the case that are primarily kind of SME tenants and more smaller floor plates. They're not moving, they're willing to pay higher rents. In the larger size floor plate like Odaiba, you're seeing significant increases in vacancies. This is a harder building to lease. We think we will lease it up fully. We thought we were going to get it done sooner rather than later. I think I guided everybody to about a year from now, but maybe it may take longer than that. I'm looking carefully about what we need to do for the asset. I mean, to give an example, it competes with, it's a former headquarters building. It's beautiful. It's super high spec. Not only is it sustainable, it's super high spec. And it's tall. It's a tall building. And it generally competes with kind of tall buildings in the middle of Tokyo. And so what's the difference between this tall building and the tall building in Tokyo? Take a look at the picture on the page. This tall building doesn't have anything around it. So if you wanted to kind of differentiate and explain why this asset is more interesting than a Central Tokyo asset, a Central Tokyo asset is like a tall building in Manhattan. You generally don't get a view unless you over the park. In this case, it's got a view. I mean, like a spectacular view. And so, again, trying to understand what is distinct and valuable, meaning kind of distinctive and therefore valuable to people. Distinctive as needs to be valuable is important. So we're working on this, but this has been, the good news is we're overwhelmingly in small, mid-sized office. It's what we've done. It's what we continue to do. We're beating the business plan on this asset, but it is proving to be a very different leasing environment than everything else we own. Page 25, page 26, for the 6th year in a row, we're in DPX DP 400. Page 27, we believe in doing buybacks when the shares are cheap. That's been ongoing, and we fully expect to continue to be ongoing. And page 28, we have a J League shareholder program. We are a top partner for the J League that supports Japanese football league or soccer league, depending which word you want to use. Which was relatively shut down during during COVID, but it's about to come back. So that's really exciting. We get all these tickets, and generally, companies, at least Japanese companies, take those tickets and give them to staff, and use them for business events. We work for shareholders, and so we've chosen to give these all away to our shareholders, not only of this company, but our two REITs and our listed solar power producer. So those are my prepared remarks, as it were. Thank you so much, everybody. We're going to turn to Q&A, and I'm supposed to guide you through this. So hopefully you're familiar with Zoom. You can either click raise hand if you're on the app or the browser. And I think you actually have an ability to do something interesting if you're on the phone. Are we going to show that page? On the phone, you also can enter *9 and then re-enter *9 to answer other questions. So those of you who are on Zoom or on the phone, we are open for Q&A, comments. Rarely get comments, but we do value them. We work for all of you. So anyway, looking for anything from anybody. Greg, do you have a question?
Yes, can you hear me?
Yep, we got you. Thanks so much.
Yes, I've got a couple of questions, please, Scott and the team.
Sure.
First, you made a comment regarding, the gain on sales as a multiple of appraisal value.
Yeah.
So in presentation, it says, 1.4 times for the more recent period, but you expected that to go back to 2 to 2.5 times. So
Yeah.
I assume because the latest sample of sales, so to speak, is not very representative. Is it too small to matter? Is that correct, or?
That's right. I mean, we disposed the regional residential portfolio effectively at cost. So, and it's a one-off. And so, yeah, we think 2 to 2.5 is the right metric to think about us going forward.
Understood. So that was affected by the residential portfolio. Okay. And then my second question is, as you pointed out, the Ichigo owners continue to be very strong. My understanding is not fairly hard to actually source, properties to buy, and obviously price per tsubo have gone up.
Yeah.
Are you seeing that we're kind of near a peak, at least in terms of volume? Do you see things slowing down a little bit after COVID, or are we continuing on the same trend? Thank you.
Greg, we're seeing no slowdown at all in the owner's business. Meaning it's interesting. COVID has been terrible for the world, but as you look at stock markets, you look at real estate prices, it's not been terrible for them. And so you have slightly different tendencies in the various asset classes, but because Japan, by the way, is experiencing, as you know, absolutely no inflation. So it continues to have interest kind of floored at zero. The implication is that you get no return out of bonds, and so people are desperate for yield. And residentials have been performing so well. We have just massive demand for those assets. As you know, our business model is we So how is it we earn the return that we do in this business? We agree with developers that will buy, and so these are very small and fast developments, multifamily, in good areas. So we'll do due diligence on a development. We'll agree to buy it 18 to 24 months down the road. We don't take the development risk on it. It needs to be built to spec. In return for us agreeing to buy it, these tend to be relatively smaller developers. They can take the contract from Ichigo, go to a bank and get it financed. So that's one thing we do is we enable these smaller developers to get kind of better financing, and they're willing to give us a spread for that. And the second thing we do is we lease these up. So we'll buy them empty and we'll lease them up. And we've got a very good leasing team. And so those two are what we deliver. And so one we have, and what we're doing to our final client is we're delivering kind of the economics that come from that better pricing from the developer, the economics for the risk and taking on leasing, and we don't think there's a lot of risk there. Meaning kind of we do this on these assets and understand what we can do with them. We're very experienced in leasing. And that's a value add that we create. The third one is we're professional real estate investors, and we know these assets and locations really, really well. So our investors are paying us for that. The gross margin is a little bit of 10%. They're not paying us a lot. So we think it's actually extraordinarily good value for the investor, and the investors agree. So at this point, we're doing about, I told you our acquisition, we expect to do about 30 billion yen. It's a little bit less than 300 million US per year. I think likely, Greg, that goes to more like 40 billion yen, 50 billion yen. It's a very successful business model. It's, yeah, I see no slowdown in it at all.
Understood. Thank you.
Thank you. Happy to take other questions or comments.
I'll have another one if no one is asking.
I'm just pausing. It looked to me, Greg, like you had a question. I was waiting to be told that you do. Thank you for announcing yourself. Go for it.
Yes. So just on the green energy business, as you mentioned, this transaction for JRE by ENEOS is quite huge.
Yes.
Do you expect we see similar transaction from other utilities trying to make their asset or their business greener? And are you trying to kind of step up in terms of investment on that front to try to accumulate an attractive portfolio there? Thank you.
Yeah, what's interesting is I think the answer is yes. I mean, energy companies all over the world are feeling tremendous pressure from zero carbon, as they should. And so trying to figure out a path forward that's not dependent upon fossil fuels is important, literally, to their survival. So that was a great transaction to see. We need a bunch of work on understanding it. The headline megawatt numbers on that is basically kind of fivefold bigger than us. I just told you, though, the true economics are going to be, in terms of the true economic size, is going to be substantially smaller than that. It also includes Taiwanese assets, and we understand kind of those economics better. Japan has had kind of much better returns to it. So understanding the amount of that, the amount of kind of offshore wind, which is not very profitable. On that basis, we'll have a better understanding of how our portfolio positions relative to JRE. But it has been our view that we have clearly somewhere between, we think, kind of 50 billion and 100 billion yen of unrealized gains in a clean energy portfolio, and this would suggest that view is accurate and going to the high end or perhaps above the high end would be important. And so on the second point, do we want to do more? Yes, and we're actively involved in doing more in sustainable and what we call clean energy.
Understood. Thank you.
Thank you. We have a question from Richard. Richard, are you there?
Oh, hi there. So can you hear me now?
Yes, yep, got you.
Okay, perfect. Thanks for this. Yeah, I was wondering, could you elaborate a little bit on the rise in depreciation costs for your sustainable real estate? It was a significant jump, and was it just purely for the Odaiba building? And yeah, was this unforeseen, or maybe you can elaborate a little bit on that, please?
Yeah, so I mean, look, depreciation is a non-cash expense, and it matters because assets will lose value over time. But the good news is that you have this extraordinarily accelerated depreciation regimes, and so these are buildings that will run for 50 years, for 70 years, 100 years. You have a little bit of maintenance capex in it, of course. So what I'm telling you is that the accounting depreciation, which is a tax shield, and that's why we like it, is much, much higher than the actual economic depreciation. And so this is actually, which are not kind of existing buildings that we had that suddenly have higher depreciation. This is us bringing online. It's primarily, we brought on 2 brand new hotels in the Knot series, a brand new hotel in Hiroshima and a brand new hotel in Sapporo last year. And that's where the new depreciation allowance is coming from.
Okay. So this is basically using the current accelerated depreciation tax scheme for those 2 new assets, and basically, yeah, okay.
And we prefer to call it a tax shield rather than tax scheme.
Yeah.
But exactly. It is part of the tax rules. It helps protect cash for all of you. And yes, that's exactly what it is.
Yeah, okay, thank you.
Thank you. Let's see. I think we have Will next. Will, are you there?
Yeah, hi, Scott. I am going to have to, there we go. I asked a question on the iPad in text, so I'll just repeat those.
Sorry, you missed it.
Yeah, just quickly, I heard, so hotels were beneath or below expectation, but just maybe a quick recount of in the second quarter, what was below expectation, or basically was it in line with expectation, despite the low, I guess 4% margins on the asset sales, or a bit of anomaly. It's happened in the past once or twice, but that was an anomaly. So excluding that, what would you say is in line or beneath expectations in the second quarter? And then roughly for the second half, are there trends that you saw in the second quarter that are going to continue that are disappointing, or are you pretty much confident in the second half? So that would be question one. And then while I'm at it, the second question is related to green energy, which everyone's asking about. And I always ask this, but I'm going to prod you again. I mean, isn't it, that transaction that Goldman does, them obviously using the market, a robust market, to exit at the right time, isn't it tempting to maybe exit a little bit of your portfolio in order to perhaps reinvest in other opportunities? That's the second question. Thank you.
Okay, so H1's first half, Will, was bang on, exactly as so the numbers that you see here were there's no disappointment and no kind of particular upside relative to our expectations. So going forward, two negatives. One I already touched on. One is that the hotel market looked like it was returning, and then it just got crushed by the surge in COVID cases. And so we think, and now again, the surge in COVID cases itself has been crushed. So we think hotel earnings have probably been pushed back, and that's twofold. That's one, occupancy. So it's been pushed back, whatever it is. We'll find out together what the government does with go-to travel, et cetera. Has it been pushed back 3 months, 6 months? Could be more, because particularly our not, which is boutique hotel series, It's been proven extraordinarily attractive for inbound tourists, primarily US and European. So we don't think we're going to get full economics out of, particularly the not in Shinjuku, Tokyo, in Hiroshima until we have inbound back. So that could be, but that will happen some point, presumably in the next 2 years. So anyway, you had a little bit of pushback in hotel revenue, a little bit of pushback in time in sales activity in hotels. And I think, we'll all find out together, but given that Japan is now 3 months ago, people were excited about buying Japanese hotels when we had COVID cases that were massively higher than they are today. So I think it's probably a reasonable assumption, and we'll find out together that market comes back, and we'll be selling hotels at the levels that we think are saleable in the next 3 to 6 months. So that's just probably a 3 to 6 month delay on hotel earnings, which will impact the second half. And the second thing that's a negative is, Odaiba is proving harder in leasing than we may have expected, meaning that we're seeing kind of bigger vacancy in other large scale assets and other owners trying to fill those assets. And so very specifically what's happened is we've had a few cases where we've had tenants kind of sign effectively, MBU would be the wrong word, but say, okay, we're going to move to you. We need to kind of issue our notice to our existing landlord, and then see the existing landlord kind of provide a very, very powerful counter offer to it. And it tells you, and that's not happening at all for us in small offices. So the large office space, unfortunately, it's big enough to matter. It's 10% of the total assets, but it's only 10%. For those folks who own a lot more large office, it's a very difficult period. And we'll have to figure out together whether or not this is a particular point in time with COVID, or in fact, work from home has had an impact on large office that's distinctly different from small. On the good news part of things, owners is roaring ahead. We worried about our ability to buy assets, and there has been some increased competition, but actually we are proving to be more than competitive in getting assets at levels that we want. So that is a surprise on the upside, and will be a driver for earnings going forward. Two, the fact of the matter is that COVID is kind of receding in Japan means the country opens up. The collapse in cases has been much more rapid than we thought was going to happen. Than anyone thought was going to happen in the last couple of months, and that implies an acceleration of economic activity that will be powerful for hotels. So it's a little bit of a counter example to what I just said about the earlier pushback in hotel earnings. Broadly speaking, for us, we have been waiting out COVID, and so there are, they give you an example of the sustainable energy space. We're super community oriented. We'll never do a power plant without local community approval. It's been hard to meet with municipalities over the last 6 months because of COVID. And so there has been a pushback in development of our clean energy pipeline, because we're not, if you come from Tokyo, we're not going to meet you. And so that is opening up. That's super exciting. And so to your question is whether the timing might be appropriate for us to do something in clean energy. Yeah, it could be. We are very open to that. We'll do a bunch of work on it. We're certainly, I don't know that it's the case that we're going to announce on our earnings call what the plan is, but there could we're certainly capable of doing a large transaction, and at the right economics, we will do that large transaction. So again, we loved this NEOS JRE transaction. Did I get to your questions?
Okay, yeah, thanks very much.
Thanks, Phil. Happy to take more questions or comments. Will, I think you're back.
Yeah, I mean, what's the most attractive space right now for investment in your view, in just terms of asset class, and you know, why? I suppose. Thanks.
Yeah, that's a good question. If we can get solar done, it's clearly the best. I mean, those continue to it just has. So our view, and it's a hypothesis, and you test your hypothesis against kind of evidence as it emerges, is that the market continues to substantially underprice post-FIT earnings of these renewable energy assets. So in other words, you had a 20-year FIT. There have been changes to that, but for those assets that still qualify for the FIT, and of course all of ours do. It's like, okay, after 20 years is up, what are your economics going to be? And it's so clearly the case that Japan can't meet its sustainable energy goals without more ongoing and growth in sustainable energy, that we think those economics are likely to be very powerful. And solar's, without question, the most cost competitive. There are regulatory changes underway to allow, for example, more agricultural land to become dual use for solar. We like wind a lot too, land-based, not ocean-based. And I've talked about that before. Japan has this huge fall off in the continental shelf, and it's really, really tough to make the economics work. We think offshore wind is about 7 times more expensive than solar. So that's the place to be, and we're working on it. And as I told you, it's been hard to meet people during the COVID period. So as we come out of the COVID freeze, that's a place where we want to be very, very active. In terms of more classic real estate assets, real estate is so specific. I mean, it's not only kind of what area, it's like what building. And in our case, what we can do with the building. But we think small and mid office is very compelling, in part because the challenges I described in large offices, which are a huge part of the market and impact investors in the office market, have kind of scared them off. And we're seeing totally different economics, total different durability, and uplift in rents available. So we really like office a lot. Hotels are going to be a growth engine when COVID comes back. Well, the reason why I'm not mentioning hotels right now is because we have possibly, for inbound to come back, which is going to be the big driver, we think, full hotel economics in Japan, and particularly for us. I don't know. Well, I mean, we'll have to figure that. We'll learn together. Is that a year away? Is that 18 months away? It's probably not 6 months away. So, and you have some risk around it. We've clobbered Delta for the moment. Is there going to be something else that comes up? So because of the volatility of the sector and the terrible current economic performance, we're not kind of deciding to make a big bet there.
Great. Thanks very much, Scott.
Thanks, Bob.
Thanks for your presentation.
Thank you for joining. We're grateful to all of you. Open for, again, more questions or comments. Are we done? This could be a going once, going twice. Okay, I think we're done. Thank you, everybody. We appreciate your time. It's still a tough time in the world. So everybody, take care. Be safe. Have a really good day.